Why November? Because the forces gathering now will accelerate and crystallize before year end. The clock is ticking. The window is open, and soon it will narrow. There's a quiet shift happening underneath the surface of our financial system, one that few recognize until it's too late. Currencies, for decades seen as stable foundations, are now competing in a race for trust, and trust once lost is rarely regained. The world has relied too heavily on one currency, one dominant anchor, and that over-reliance is beginning to show its cracks. History reminds us that when a system concentrates too much power in a single instrument, it eventually invites imbalance, volatility, and ultimately change. We've lived through a cycle of unprecedented monetary expansion. For years, easy liquidity and aggressive fiscal intervention masked underlying fragilities. But the more one currency is weaponized, whether through debt, trade leverage, or policy influence, the more the world begins to look for alternatives. This is not a theoretical shift, it's already in motion. Nations are diversifying their reserves, companies are exploring multi-currency trade settlements, and individuals are turning toward decentralized systems of value. The search for independence is becoming a defining theme of this decade. When I think about how to position for this transition, I think about resilience. Resilience is not built on uniformity, it's built on diversity. The future investor will not rely on one currency, one economy, or one narrative. They will seek exposure to multiple stores of value, real assets, innovation-driven equities, productive technologies, and yes, even digital forms of money that aren't bound by political borders. Because when systems evolve, capital must evolve with them. There's something deeply structural happening here. The era of single currency dominance aligned with the post-war industrial world. It thrived when information moved slowly, and economies were tightly interlinked through centralized trade systems. But today's world is decentralized by design. Innovation travels instantly. Borders matter less than algorithms. Economic power is shifting from manufacturing to data, from commodities to computation. And yet, our monetary infrastructure is still clinging to the past. That misalignment is creating one of the greatest investment opportunities of our generation. Many will tell you that diversification is defensive, but in this context it's offensive. It's a strategy of foresight. Those who build exposure beyond a single fiat system are not betting against it, they're preparing for what comes after it. As inflation cycles ebb and flow, as debt loads climb, as fiscal policy becomes a political tool rather than an economic one, the currency you rely on becomes a variable, not a constant. And when the constant disappears, volatility becomes the new normal. We are at an inflection point. You can sense it in the way markets are moving, erratic, uncertain, reactive. You can sense it in the way policymakers speak, assuring stability while printing instability. But the most telling signal is behavioral. People are losing faith in promises and searching for proof. And proof in this new era comes from transparency, decentralization, and verifiable value. That's where the next wave of wealth creation lies. This doesn't mean abandoning the system, it means adapting to its evolution. Think of it as recalibrating your compass. For decades, the magnetic north of global finance pointed toward one direction, one currency. But as innovation redraws the map, that compass is shifting. Those who continue to rely on a single reference point will find themselves disoriented, while those who diversify their anchors will navigate with confidence. The idea of trust is being redefined. It's no longer given to institutions by default, it's earned through transparency, performance, and adaptability. And that's where the future lies, in systems that can't be manipulated by decree, in assets that reflect real productivity, in innovations that generate value independent of monetary policy. If the past century was about scale and centralization, the next will be about decentralization and autonomy. The world is moving from dependency to distribution, from reliance to resilience, from control to collaboration. That's the underlying message of this era. Don't rely on one currency, because the future won't rely on one either. We're witnessing not the end of an era, but the beginning of a more balanced one, where money, technology, and value interact more organically, where markets reflect merit, not manipulation, where investors aren't hostage to the policy choices of a few, but empowered by the innovation of the many. The transition won't be linear and it won't be smooth. Change never is. But if you believe, as I do, that innovation tends to outpace regulation, then you know where this is headed. Currencies evolve just as industries do, and those who prepare for the evolution, those who build exposure to real, productive, adaptive assets, will emerge stronger than those who cling to yesterday's structures. So as we look ahead, remember, no single currency, no single system, no single institution defines the future. Innovation does, human ingenuity does, and the freedom to adapt, financially, technologically, and intellectually, will be the ultimate hedge in the decade ahead. The world is shifting beneath our feet, quietly but profoundly. We've built layers upon layers of abstraction, derivatives, digital credits, dead instruments, promises stacked upon promises. For years they worked. They gave us convenience, leverage, the illusion of control. But every abstraction distances us from the tangible core of value, and when systems become too detached from reality, they eventually need to reconnect. That's where the next great opportunity lies, in owning real things. Throughout history, moments of financial excess have always been followed by rediscovery of value, of scarcity, of what truly matters. We're at such a point now. As liquidity floods markets, as paper assets multiply faster than production, the divide between perception and reality grows wider. But eventually capital seeks substance again. It seeks grounding. And those who own real things, productive assets, tangible innovations, scarce resources, will not just preserve wealth, they will compound it. Real things aren't limited to commodities or land. They are the assets that create, that produce, that generate real output. In a world fueled by speculation, owning something that has intrinsic value, something that makes, that grows, that scales, is a rare advantage. It's a hedge against monetary distortion, but also a participation in genuine progress. The companies building the technologies of tomorrow, the infrastructures powering digital ecosystems, the intellectual property that enables exponential growth, all of these are real. They are the new foundation beneath the digital surface. There's a kind of clarity that comes when markets are noisy. When speculation becomes the dominant narrative, the most valuable decision you can make is to return to fundamentals. To ask what's real, what's durable, what will still hold value when sentiment shifts. The answer is always the same. It's what creates, not what copies, what serves, not what speculates. We've been conditioned to think of ownership as passive, but owning real things is an act of conviction. It means you're aligned with production, not perception. It means you trust in innovation, not imitation. It means you're participating in the next era of value creation rather than trading shadows of the last. The future belongs to those who understand that wealth is built by being connected to the source, by owning what the world needs, not what it merely wants in the moment. We're entering a decade where scarcity will redefine strategy. Scarcity of clean energy, scarcity of natural resources, scarcity of trustworthy data, scarcity of time. The assets tied to solving those scarcities will be the most valuable of all. So when I say, own real things, I'm speaking about more than a portfolio shift. I'm talking about a mindset, a move from speculation to substance, from abstraction to action. Inflation, debt, and monetary manipulation can erode the value of paper promises, but they can't erode what's real: a productive company, a renewable energy network, a breakthrough in AI, a life-saving genomic technology. These are things that can't be printed, copied, or inflated away. They represent true value creation, and they will define the next era of growth. Owning real things also means trusting innovation cycles. Every major technological revolution, electricity, automobiles, the internet, went through phases of hype, collapse, and then exponential growth. The winners weren't those who speculated on the hype, but those who owned the underlying change through its volatility. True ownership is patient. It's informed. It's grounded in understanding, not emotion. There's another dimension to this. When people lose faith in currency, they rediscover assets. When they lose faith in systems, they rediscover sovereignty. And sovereignty, in today's context, means having exposure to things that don't require permission to exist. That's why ownership matters more now than ever. Because it's independence. It's the ability to stand on something solid while the world recalibrates. So what does that mean for the investor today? It means stop chasing noise. Stop confusing liquidity with value. Stop believing that numbers on a screen represent wealth. They don't, not unless they connect to something tangible, productive, real. The market has rewarded speculation for too long, but cycles change, and as this one turns, fundamentals will matter again. The assets tied to innovation, productivity, and scarcity will outperform. Owning real things is how you bridge the gap between today's volatility and tomorrow's opportunity. It's how you protect purchasing power in a world of monetary distortion. And it's how you align with the future that's being built, not the past that's fading away. There's a reason the great investors of every era returned to the same principle: own what endures. Technology evolves, currencies fluctuate, policies shift, but creation, real, measurable creation, remains the ultimate store of value. So, as the noise grows louder and the screens flash faster, take a breath, look deeper. Ask yourself what you truly own, because in times like these, conviction in real things isn't just an investment strategy, it's an act of clarity, and clarity, in uncertain times, is the most valuable thing of all. There is a misconception about diversification. Many think of it as spreading bets, as a defensive posture, as something you do when you don't know where conviction lies. But real diversification is not about fear. It's about foresight. It's about understanding that the future rarely unfolds in a straight line, that innovation doesn't move in harmony, and that risk, when concentrated, can destroy even the strongest thesis. True diversification is protection not from volatility but from blindness. We live in a world where correlations are rising, where assets move together not because they should, but because algorithms, liquidity, and sentiment link them in milliseconds. It feels safe until it isn't, and that's the danger of thinking one theme, one region, or one currency defines the entire opportunity set. When you concentrate too narrowly, you mistake familiarity for safety. When you diversify intelligently, you prepare for what you can't yet see. In every cycle, the same pattern repeats. People chase what worked in the last bull run. They double down on what's familiar. They forget that innovation shifts leadership faster than most models can track. The technologies, companies, or sectors that define one decade rarely define the next. So diversification isn't dilution, it's a recognition of evolution. It's positioning across different curves of progress, understanding that exponential change never flows from one source alone. Think about what's happening today. Artificial intelligence, robotics, energy storage, and genomics. These aren't isolated revolutions. They are converging, feeding off one another. Each breakthrough accelerates the others. Diversifying across these intersections isn't just protection. It's participation in the future's full potential. Concentration may make you look brilliant in 1 year, but diversification is what keeps you in the game for decades. The hardest part about this principle is psychological. Humans crave simplicity. We want a single answer, a single narrative. We want to believe that one asset class, one company, one technology can carry the entire portfolio. It's comforting until it's costly, because disruption doesn't send an invitation before it arrives. The leaders of one era often become the laggards of the next. That's why diversification is not a hedge against failure, it's an alignment with progress. Some argue that diversification dilutes returns. That's only true when you diversify without conviction, when you scatter capital without understanding. But diversification rooted in research, in the identification of transformative trends, is not dilution. It's strategy. It's the recognition that innovation is not linear, that breakthroughs happen where disciplines collide, and that no one can predict precisely which catalyst will lead the next wave. By holding across multiple vectors of disruption, you capture the asymmetry of innovation without exposing yourself to the fragility of concentration. The market often rewards the concentrated until it doesn't. Then it reminds everyone, brutally, that balance is not weakness, it's wisdom. Protection doesn't mean avoidance, it means endurance. The investor who survives every cycle is the one who builds a foundation broad enough to absorb shocks and flexible enough to seize new opportunities. Diversification is also philosophical. It reflects humility, the acceptance that no one knows everything, that even the best forecasts have blind spots. The most successful investors aren't those who never get it wrong, but those who structure themselves so that being wrong doesn't destroy them. In that sense, diversification is the architecture of resilience. It's how you keep optionality alive. We are entering an age where innovation cycles will overlap faster than ever. A breakthrough in computing will accelerate drug discovery. A shift in energy technology will reshape manufacturing. A new financial protocol will redefine access to capital. You can't capture the full impact of these transformations by concentrating on just one domain. The future is multi-layered, multi-directional, and deeply interconnected. Your portfolio should reflect that reality. Protection in this context doesn't mean retreating to safety. It means participating intelligently. It's about ensuring that your exposure to progress is balanced across multiple fronts. It's about protecting yourself from obsolescence, not just loss. Because the greatest risk isn't volatility, it's being left behind. When the market corrects, those who diversified don't panic, they reallocate. They don't see red, they see opportunity. Their exposure to different innovations allows them to shift capital dynamically, moving toward areas of acceleration while others are frozen by uncertainty. That adaptability is the essence of protection. So as you think about where to allocate today, remember this: the future won't reward the narrow. It will reward those who understand the mosaic, who can hold multiple truths at once, who can see that progress is fractal, not focused. Diversification is not about playing it safe, it's about staying aligned with a world that refuses to move in one direction. Protecting your portfolio is not about avoiding change, it's about embracing it fully, across its many dimensions. Because in a world defined by rapid innovation and constant disruption, diversification isn't just a defensive strategy. It's the ultimate expression of conviction in the future. The most powerful forces in markets are often invisible in the short term. They move slowly, quietly, almost imperceptibly, until they don't. Then suddenly the world shifts and everyone calls it unexpected. But nothing about it was unexpected. It was simply the culmination of a long-term cycle. To think long-term is to recognize these deep undercurrents, to see beyond headlines, beyond quarterly noise, beyond the anxiety of the moment. It's to understand that value is rarely created in reaction, it's created in anticipation. Markets have rhythms. They expand and contract. They overvalue and undervalue, they forget and rediscover. Every era has its own story: the boom of industrial expansion, the digital revolution, the policy-driven liquidity surge. But beneath each short-term frenzy lies a longer arc of transformation. Those who align with those arcs, not by guessing their timing, but by believing in their inevitability, build generational wealth. Thinking long-term requires courage, because it means being misunderstood. The market rewards the immediate, the human brain craves confirmation. But cycles don't care about sentiment. They care about fundamentals, about innovation, about productivity. They reward patience and punish panic. Every major innovation, whether the internet, electric vehicles, or genomic breakthroughs, was born in a moment of skepticism. The best opportunities always look unreasonable at first. That's what makes them powerful. Short-term thinking is easy. It's driven by emotion, by data releases, by the need to appear active. But short-term movements are often noise layered on top of signal. The signal is the long-term cycle, the slow, compounding shift in how the world creates, consumes, and connects. You can't see it in daily volatility, but you can feel it in direction. It's the difference between trading weather and understanding climate. When you think long-term, downturns become opportunities. They are not interruptions, they are recalibrations. Every correction plants the seeds of the next expansion. The challenge is psychological. We are conditioned to fear drawdowns because they're uncomfortable. But cycles don't reward comfort. They reward conviction. Long-term investors use downturns to accumulate, to build positions in assets that the short-term crowd has abandoned. They know that innovation doesn't pause when prices fall. It accelerates as capital becomes more disciplined. We're living through one of those transition points now. The past cycle was driven by liquidity, low interest rates, and financial engineering. The next one will be driven by innovation, productivity, and technological convergence. But transitions are messy. They confuse, they disrupt, they test patience. That's why understanding cycles is so essential, because it gives you perspective when the noise gets loud. You stop reacting to volatility and start anticipating trajectory. Every long-term cycle begins with disbelief. Early adopters see it first, often mocked for their optimism. Then come the builders who create infrastructure. Then come the investors who scale it. And finally, the crowd, who arrives when it's already obvious. If you're thinking long-term, your goal is to position yourself somewhere between the builders and the early believers, to act before consensus, to hold through doubt, and to scale when conviction is scarce. Thinking in cycles also means accepting imperfection. Timing will never be exact. The goal isn't precision, it's participation. Missing a short-term top or bottom means little when you're compounding across decades. What matters is direction. Whether you're aligned with innovation, productivity, and value creation, or trapped in the inertia of the old cycle that's fading away. There's a deep irony in markets. Everyone wants to think long-term, but few are willing to look foolish in the short term. That's why opportunity keeps rotating. Those who can endure temporary pain capture permanent gain. Long-term cycles don't announce themselves, they reward those who prepare quietly. When you zoom out, every disruption, every bubble, every correction fits into a larger pattern. Economies evolve, technologies converge, policy regimes shift. Each cycle plants the foundation for the next one. The investors who thrive aren't those who predict every turn, but those who understand the continuum. The way innovation compounds over time, the way human behavior repeats, the way new ideas replace old paradigms. Patience in this context isn't passive, it's strategic. It's the ability to hold conviction when the market is testing it most. It's knowing that value creation doesn't happen on a quarterly schedule. It's trusting data, research, and direction more than noise. And it's having the discipline to stay invested when fear dominates headlines. If you've studied long-term cycles, you know this moment feels familiar. Disruption is colliding with skepticism. Innovation is accelerating, but belief is lagging. That gap is opportunity. Those who see beyond the current volatility will own the future that others only recognize in hindsight. The secret isn't predicting when the cycle will turn. It's preparing for when it does. Because when the next expansion begins, it won't wait for the hesitant. It will reward the patient, the focused, and the forward-looking. That's what thinking long-term really means: believing in progress, trusting compounding, and staying positioned for the inevitability of change.